A very good afternoon to one and all. I am Sushma to moderate this session. Thanks for taking your time to make this webinar a knowledge sharing initiative from ADP useful for both of us. Today's webinar, how important is tax computation for your payroll? This is yet another interesting webinar from ADP. This is an initiative from ADP to help HR leaders and key decision makers of organizations manage sensitive aspects of the HR process as per the business trends today. We aim at providing the maximum inputs to the audience with the latest market insights. Our presenter for the day is Mr. Ramesh. Mr. D. Ramesh, Associate Vice President, Implementation and Compliance Services at ADP India, has 14 plus years of expertise in compensation and benefits, payroll process, statutory compliance, business process improvements, and he is a Six Sigma Green Belt. He has vast experience in compensation structuring, salary-related tax advisory services, and individual tax planning. Before starting this session, we would like to thank each one of you to have taken your valuable time for joining us. We would like to keep you informed that all of you would be put on listen-only mode. We encourage our viewers and participants to put forth questions that are related to today's topic and agenda in the chat window. We will be pleased to answer those in the end of the session. Over to Mr. Ramesh.
Thanks, Sushma. Thanks for the introduction. Good evening, everyone. I welcome you all for this next 45 minutes webinar focus on the fundamentals of payroll and taxation. The agenda for the day today is I'll be covering briefly about what is payroll, what are the components involved in the payroll processing, some of the statutory remittance due dates which are linked directly to the payroll statutories. Then I'll briefly cover about the income tax deduction process and what are the fundamental tax related income tax rules you need to keep in mind while processing the payroll for your employees. Okay, let's understand what is payroll. So in the payroll, we have four components involved in the payroll. One is employer paying certain things to employees, employer paying certain dues and other government remittances to the government or others, and in the payroll there are certain components where employee pay to employer, then employee pays to government or other financial institutions. So let's understand what are the things employer is paying to employee in the payroll. In the payroll, employer pays fixed salary, the reimbursement components like medical, LTA. There are certain non-monetary benefits the employer pay to the employee, which will be in the form of car per accommodation perquisites. So those are all the benefits which an employee gets through the payroll processing. Then certain retirement benefits like provident fund, gratuity, superannuation fund, and employer is also responsible to issue certain statements at the end of the year, which is like form 16. In the payroll, the employer, as an employer, they are also responsible to make certain payments to the government, which is provident fund, 12% of the basic which has to be contributed by employer to the provident fund. Yes, again that provident fund is divided into two parts from the employer contribution. One part goes to the pension fund, which is 8.33, and the remaining 3.67 goes to the PF fund. As an employer, they need to contribute to the social security benefits, which is ESI, that is 4.75% of the gross salary, to the government account. Similarly, in certain states where the employer also has to pay labor welfare fund, which will be equivalent to the employee contribution or little higher than the employee contribution, depends on the state as per the state law. And then in the payroll, there are certain payments will being done by employee to employer. So what are those payments being done by employee to employer in the payroll? Loans. If an employee has taken any loan from the company, they have to pay back to the employer. So these payments are being made through salary. Similarly, if they are taken any salary advance, a travel advance, a tour advance, and employer has to pay back this to the employer, the payment will happen through again payroll as a deduction. And if there are any society payments, if there is a manufacturing industry or industries where they have their own employee societies, where there are certain payments, as an employee they have to make payments to the society contributions, that is also being made through payroll. And ESOP contributions, if an organization is giving ESOP benefits to the employees, then the employer has to contribute a certain amount to get the ESOP shares and benefits. Apart from that, if an employee wants to make any payments to the employer, it can be in the form of penalties or internal dues. Say for example, if an employee has misplaced certain assets or data cards or any instruments provided to the employer, if they have to pay back, then the payments are also being made through payroll. That what are the things through payroll an employee is paying to government or others? So the employee contributes. One of the important thing contribution is provident fund. 12% of the basic again employee contributes to the provident fund. Employee again contributes to employees state insurance, which is social security benefits, is again 1.75% of the gross. Then being an employee, the employee also has to contribute to the labor welfare fund, professional tax, and whatever the income they have earned, they have to pay income tax for that earnings. And if they have any life insurance, salary saving life insurance schemes, or if there are any loans taken from bank, and if the deduction has to happen through salary, then the employee will also make these payments as a deduction through salary. So payroll is nothing but the four elements. That's what we have covered here in the slide. So it's basically, there are certain payments employer is making to employee, employer is making on behalf of employee to the government account, then employee is paying back to employer certain payments which is in the form of deductions. Similarly, employee has to pay to the government or others. So this is what the payroll. So let us get into and understand what are the components involved in the payroll structure. So typically, if you come across, these are all the components you will come across in the salary structure. So basic, generally it will be 40 to 50% of the CTC. House rent allowance, which will be 50% of basic for metro cities, 40% of basic for non-metro cities. Conveyance, the maximum allowed is 9,600 per annum. Child education allowance is 100 per month per child. This is whatever the structures I'm briefing here is a common salary structure you come across in any organization. Medical reimbursement of maximum 15,000 per month. Leave travel allowance, generally it will be paid as a 1 month's, and basic will be paid as leave travel allowance. Food coupons to the extent of maximum 1100 per month. Telephone reimbursement, again companies will provide band wise or grade wise, starting a minimum of 2000 to a maximum of 4000, depends on the salary levels. Similar vehicle maintenance, there are two types of vehicle maintenance here: employer car, employee car. So what is that? If it is employer car, expenses also, maintenance and fuel expenses met by employer. Generally, as per law, there is no limit, but we will come across practically maximum up to 10,000 per month can be provided by the employer as a vehicle maintenance. If it is an employee car, fuel and maintenance is being taken care by employer. Then 1800 per month for small car, 2400 per month for the big car. So you always come across special allowance or other allowance. So this is nothing but a difference between the CTC amount minus all other allocated components. Generally it will be taken as a balancing figure in most of the organization. Then we will also come across in the CTC employer contribution to provident fund, employer contribution to gratuity, group medical insurance. All those things will be part of the salary structure. So when it comes to payroll, so all these components, how it is being arrived as a net salary. So again, the payroll is being divided into earnings and deductions. In earnings, you have three basic components will come under earnings. One is fixed component, which is basic dearness allowance, house rent allowance, conveyance and other things. Variable earnings, which are being paid for the month based on certain completion of certain categories or completing certain KPIs, which is bonus, incentives, leave encashment, which will be paid once in a year, depends on the company policy, overtime, shift allowance. So all those payouts are generally variable in nature. Then reimbursement, which are part of your salary components like medical, LTA, telephone, all those things will be part of the earnings. Then you have a deduction. Again, deductions are again divided into three parts. There's a fixed deduction, variable deduction and statutory deductions. Fixed deductions are generally loans and advances. Variable deductions are again very clients, company specific, where you come across transport, mobile, canteen deduction. Statutory deductions are PF, ESI, professional tax, labor welfare fund and income tax. These are statutory deductions. So the earnings minus deduction is the net salary. That's how you come across payroll. So apart from that, companies do take care of the full and final settlement, where generally the full and final settlements for the termination or resign employee cases will be managed, most of the companies outside the payroll system. So during that period, while making the payment of full and final settlement, you will take care of the notice period payable, notice period recoverables, gratuity if there is any, leave encashment. So all those components are being taken care in the full and final settlement process. So when it comes to statutory remittances, which are directly linked to the payroll. So if you take statutory remittances, the statutory remittances are broadly into 5 categories. One is TDS, your income tax, whatever the tax which has been deducted from the employee, it has to be remitted on or before 7th of the following month. So if it is for the month of March, then you can do that remittance on or before 30th April. Otherwise, whatever the tax which has been deducted through the payroll, it has to be remitted on or before 7th of the following month. Then you have professional tax. This professional tax payment dates vary according to the state. And you have labor welfare fund. Labor welfare fund, again, payments are being made as per the state. Provident fund, which has to be whatever the provident fund which has been deducted from the employee and whatever the contribution from the employer, both has to be deposited on or before 15th of the following month. ESI, again, both employer and employee contribution has to be deposited on or before 21st of the following month. So when it comes to tax, other than depositing the tax, you also need to file a quarterly return in a form of Form 24Q. This quarterly return has to be filed for all the 3 quarters, that is 15th of the following first month quarter. Say for example, if the quarter is April to June, then on or before 15th of July, you have to file the Form 24Q. So what are the components will go into the Form 24Q? It's basically the tax deducted details, including the challan information, and you have to generate the Form 27A. It has to be signed by the authorized signatory. Then along with the Form 27A, the Form 24Q, if you file, you have to file it with the Income Tax Department. For the last quarter, which is being the annual TDS return filing, this has to be done on or before 15th of May. So the 4th quarter return, apart from the general monthly TDS statements, in the quarterly return, 4th quarter annual return, you also need to provide the complete annual information of tax deducted details to the Income Tax Department. So based on that, your Form 16 will be generated, and that has to be issued on or before 31st May. So let's understand what are the things, critical things will goes into the income tax process. So income tax, generally tax is being computed based on the income earned by the employee for the year. So the income tax exemptions are being provided based on the actual documents, evidence of investments being made by the employee. So this deduction limits vary from every year, depends on the budget, the rules will vary. So in the Income Tax Act, under section 192, it has been clearly defined the roles and responsibilities of the employer. The employer here plays the role of a tax deduction officer. So the section 192 clearly defines what are the things an employer can do. Say for example, if an employee is claiming a donation paid to a charitable institution or a trust, so these two things are not allowed, because it is defined under section 192 that ATG donations should not be claimed through employer while computing the salary. So those rules and instructions allowable deductions are defined under section 192. So in the income tax, if you take the financial year, it starts from April to March. So what actually happens during this 12 months period? So the employee declares the investments at the beginning of the financial year. So as an employer, as an organization who are responsible for payroll, you will be deducting the tax based on the declaration submitted by the employees month on month, starting from April to Jan. In the last quarter of the financial year, generally all organizations will go into a actual proof mode, where you collect all the documents from the employees related to the investment proofs. So these documents are generally, to claim HRA exemption, you need to submit rent receipt, and there are certain chapter 68 deductions like ATD, ATCC. So you have to submit all the documents. We will cover this in the subsequent session. I'll take you through each and every sections in detail. So what happens when at the end of the financial year, employee submits the proof document. Being an employer person responsible for payroll, you will be validating all the documents, whatever has been submitted by the employees as per the income tax rules. Then you will recompute the tax for the year, and this tax, whatever has been recomputed, will be deducted in the subsequent months. So it is always advisable to send the mock tax computation to the employees based on the documents submitted, so that the employees are not getting any last minute surprise at the end of the month after crediting the salary. Then once you finalize the financial year, you will be generating the Form 16 based on the document you have submitted through the Form 24Q process. The Form 16 will be generated. So as you all aware, the Form 16 again has two elements, Part A, Part B. The Part A is being generated by the Income Tax Department from the tracer site. The Part B has to be generated by the employer. So this has to be issued on or before 31st May. So I just highlighted some of the key amendments which you need to keep in mind as from the current financial year perspective. So if an employee is claiming HRA exemption, then if the rent paid by the employee is more than 1 lakh per annum, then it is mandatory that the employee has to submit the landlord PAN number details. The other key amendment which has happened in the last year is interest paid on housing loan. If it is a new loan under section 80E, other than the self-occupied benefits or the interest on let-out property benefits, you also get an additional benefit under section 80E. I'll cover this up in the subsequent slide in detail. So this is how we do as an income tax process from the payroll perspective. So let's go in detail about income tax. We'll cover some of the basic critical sections. So let's first understand what are tax slabs. So this is the current tax slab. It's a normal rate both for men and women. So up to 2 lakhs it's nil, 2 to 5 lakhs 10% slab, 5 to 10 lakhs it's a 20% slab, and above 10 lakhs it is 30%. So surcharge is applicable if the total income exceeds rupees 1 crore. And there is a rebate which is available 2,000 rupees for individuals having income does not exceed 5 lakhs under section 87A, and the education cess is at 3%. So this slab is applicable for senior citizens. I'm not getting into it because in a normal payroll processing, you will never come across senior citizen being employed in an organization. In an exceptional cases, yes, there are certain organizations do engage senior citizens on a monthly regular employment. In that case, they have a different slab rate. So make sure that the senior citizens are being directed tax as per their slab rates. Let's go into the section house rent allowance, section 1013A. So this allowance is allowed, house rent allowance is allowed only when an employee actually incurred an expenditure of rent being paid for the house which has been accommodated. So there are certain rules you need to follow. So let's get into the rules. So if it is a metro, if an employee is living in a metro city like Mumbai, Kolkata, Delhi and Chennai, then there are three conditions they have to satisfy. One is allowance actually received, which is house rent allowance actually received, rent paid less 10% of the salary or 50% of salary. Whichever is less will be considered as HRA exemption. The rule remains same for the non-residential, that is non-metro categories. Instead of 50% of salary, it is applicable for 40% of salary. The documents which are required is the proof of rent being paid, which can be rent receipt or rental agreement. And if the rent paid per annum is more than 1 lakh, then PAN number of the landlord is mandatory. If the PAN number of the landlord is not available, then you need to submit the declaration. There is a format in which you need to provide this declaration from the income tax requirement. Section 24, which talks about deduction from house property loss. So being an employer responsible for payroll, you also need to consider if an employee is having paid any interest for house property, be it self-occupied or let out, then this also has to be considered while computing the tax. So let's understand what are the types and categories of this. So the properties are basically divided into, we just made it simple for everyone to understand. A property again divided into two parts, whether it is acquired or constructed. If it is acquired or constructed, whether the property is let out or self-occupied. If it is let out, then there is no limit. Any amount of interest which is being paid is allowed as deduction. So this interest has to be set off against the income earned from that house property. There is a computation methodology available as per the Income Tax Act. Then whatever the net gain or the income or the loss has to be taken into account while computing the tax for an employee. So this net loss or gain has to be included in the salary component. If there is a loss, then you can offset this loss against the salary income. If it is self-occupied, the maximum amount allowed is 1.5 lakhs. If the loan is being taken for repairs and renewal, then if it is self-occupied, again the maximum limit is 30,000. If it is let out, there is no limit. Any amount paid as a interest you can set off against the income. So what happens if there is a pre-construction? Generally people use the term called pre-EMI. Pre-EMI is the word which is being used by the bankers, but from the income tax perspective it is called pre-construction interest, that is before the year of possession. So whatever the interest which is being paid prior to the construction period, you can claim that whatever the interest which is being paid prior to the construction period, that same interest you can accumulate and claim that benefit over a period of 5 equal installments starting from the year in which the property has been acquired. But still, that interest plus whatever the interest you will be paying for that current financial year, both put together, the maximum limit is, as per the income tax law, if it is a self-occupied, then 30,000 or 1.5 lakhs. The income or the loss from house property, again, we are divided into two parts, which is property acquired or constructed, or repairs or the renewal construction being done. So acquired or property, it's a let out or self-occupied. So if it is a let out, then whatever the amount which is being paid as a interest towards the property is being allowed as deduction, but this interest has to be adjusted or set off against the income earned from the property. If it is a self-occupied, then the maximum amount allowed is 1.5 lakhs. If it is a loan has been taken for repairs and renewal and the property is self-occupied, then the maximum amount allowed is 30,000 for that repairs and renewal loan. If it is a let out property, then any amount will be considered as let out. If there are any interest which is being paid prior to the construction period, technically it's called pre-construction interest or PEMI interest, before the possession of the house, that interest you can accumulate, and whatever the interest that can be claimed over a period of 5 equal installments starting from the financial year in which the property has been acquired. So this is again, this interest is part of that overall limit of 30,000 or 1.5 lakhs. So your employees or the owner who is not, they are not eligible for deduction if the property has not been occupied or under construction. So we're just given what is self-occupied means and how the maximum exemption will be claimed under this section. So let's get into section 80C, which is one of the critical section where most of the employees make use of this, where the maximum allowed deduction is 1 lakh. So this deduction is being allowed under section 80C are life insurance premium. Some of the critical main deductions are life insurance premium, public provident fund, fixed deposit receipts, basically is a tax saving fixed deposit receipt, education or tuition fees paid for the kids, housing loan, property payment. So these are all some of the main top 5 main deductions you will come across in your normal payroll process. So how this deductions under section 80C is being divided, there are certain things is called market linked investments, fixed income investments and others. So we just listed out what are the investments which are allowed under section 80C, which is your UTI unit linked insurance plan or mutual funds, systematic investment plans, or all those things are allowed under section 80C. The fixed income investment plans are public provident fund, whatever the provident fund which is being deducted from the employee's salary, national savings certificates, pension fund, fixed deposits, tax saving fixed deposits, all this are covered under the fixed investments category. The others are insurance premium, tuition or education fees, housing loan principals. So these are all the payments are covered under the others. So we'll also look at when it comes to 80C, how this particular investments, whether it has been allowed for self, spouse and children. So there are certain investments are being considered only if the investment is being made under the employee's name. Whoever is the person, employee, they claiming the benefits, then the investment should be in the name of the employee. There are certain investment, it can be in the name of the family members. So we have just listed on some of the activities, some of the list of investments, whether it is allowed for self, spouse or children. So PPF, it is allowed for self, spouse and children. The maximum amount is 1 lakh. And a copy of the passbook has to be produced as an evidence. Similarly, if it is a life insurance, then again it is allowed for self, spouse and children. Whereas if an investment under National Savings Scheme, PPF or other payments, then it has to be under the name of the self. So this is a new scheme which has been introduced by government, pension fund schemes. So most of the employers started providing pension benefit schemes to the employees. So this amount is also allowed under section 80C as an exemption. So again, the pension funds are being contributed both by employer and employee. So any contribution made by the employee, this will again go into that overall 1 lakh investment limit. So as per the section 80 CCD, there is a limit which has been fixed, maximum 10% of salary. Whatever the contribution which is being made by the employer on behalf of the employee towards that pension scheme is also allowed as a deduction under section 80 CCD. So this is over and above that benefit of 1 lakh which an employee claim as an investment, self-investment. So whether it is 80C or 80CCC, which is a pension fund, or 80CCD, being an employer contribution of the pension fund, all the investments put together, a maximum allowed is rupees 1 lakh. So the employer contribution to NPS will be treated as a perk, and similarly it will be deducted from the income as per the above limit. This will be over and above the 1 lakh investment available for the individual employees. So this is a Rajiv Gandhi Equity Savings Scheme which has been introduced 2-3 years before. Last year there was an amendment in this section. So there are certain prerequisite conditions an employer has to satisfy to get eligible for this deduction. One is the employee should be a resident individual. His gross total income does not exceed 12 lakhs. Acquired list shares notices, if there has been listed shares by the government of India, so then it is allowed for deduction. There is a lock-in period of minimum 3 years from the date of acquisition. So the maximum amount allowed is 50% of the amount invested or 25,000, whichever is less. So let's go back to section 80D, which is medical insurance premium benefits. So we have just given a matrix how it is being considered for self and for senior citizen. So we have taken 3 scenarios. If an employee, he or she himself is a senior citizen, then if they are contributing it for the self, spouse and for the dependent children, then the maximum amount is 20,000. If the same senior citizen employee is contributing for the parents, who is also the senior citizen, then the maximum amount allowed is 40,000. And if it is if as an employee, not a senior citizen, but contributing for self, spouse and dependent children, the maximum amount is 15,000. If they are also contributing for the senior citizen parents, then additional 20,000, the maximum allowed is 35,000. Same situation where the parents are also not a senior citizen, then the maximum amount is allowed is 30,000. So over and above the medical insurance premium, if an employer has taken any preventive health check, that is for any of the preventive health check, maximum allowed is 5,000 rupees. This 5,000 is also part of this overall limit. So it's not that over and above whatever the premium benefit they pay. So let us go and understand the deductions available for disability. So disabilities are again 2 types. If the employee is having any dependent who is disability, then there is a deduction which is available under section 80DD. And if an employee, he or she himself is a disabled person, then there is a separate deduction is available under section 80U. So we have just listed down the scenarios. So this is allowed again for resident individual. 80DD is allowed for spouse, children, parents, brothers and sisters if they are dependent for that employee. If the disability is less than 80%, then it is 50,000 fixed amount, and more than 80,000 is 1 lakh. So there are certain documents the employer has to produce as an evidence, which is Form 10IA from the medical authority for claiming the benefit. For 80U, that is allowed only for the self. Again, based on the disability, the deduction percentage varies from 50,000 to 1 lakh. So they have to produce the evidence of being disability evidences with a Form 10IA. This is section 80E, interest paid towards education loan. So this deduction is allowed for repayment of interest on education loan taken from the financial institutions for higher education. This is allowed for self, spouse and children. The maximum year an employee can claim is for 8 years. That is for the financial year in which the employee starts paying the interest, and the next 7 years the employee can claim this benefit. So for that, the employer has to produce the certificate of interest being paid to the financial institution. This is a new section 80E for interest paid on housing loan. This deduction is allowed only currently for the current financial year. So the period has been defined very clearly that any loan taken from the period 1st April 2013 to 31st March 2014, and the loan amount should be less than 25 lakhs, and the property whatever has been acquired by the employer, purchased by the employee, should be less than 40 lakhs. And previously the employee should not own any residential house property if they have to claim deduction under section 80E. So this deduction, the maximum allowed is rupees 1 lakh. So this deduction is over and above the deduction which is allowed under section house property section. 1.5 lakhs or 30,000 depends on the property value. So for that, the employer has to produce a self-declaration saying that all the 4 conditions are being satisfied and the certificate of interest being paid to the financial institution. So that's it from my end. So we have just covered basically what is the fundamentals of payroll, the components which are involved in the payroll, and we have also taken what are the statutory due dates, and we have deep dive into the income tax, the basic income tax things which are applicable for the salaried employees. So this is all we have covered in the last 40 minutes.